Hey everyone, today we'll be talking about exempt income as per the corporate tax consultation documents. We have already spoken about in the previous videos about taxable income, but in today's video we'll be speaking about what is the income that can be exempt from the calculation. Before we move ahead, please click on the subscribe button and the bell icon to stay updated on our future weekly business and finance related content, which is incredibly useful for business owners, CEOs, CFOs, entrepreneurs, and those who aspire to be one. Now let's get back to the video. It's important to understand what income is exempt from corporate taxation so that we can reduce our tax liability correctly. UAE is already a hub for international business, and the UAE government wants to attract more investors. So, in order to attract them, they have made sure that the following are exempt from corporate taxation. Firstly, dividends and capital gains income. Secondly, foreign branch profits. And finally, which is slightly different, is income earned from non-residents operating aircrafts or ships which is used for international transport. For this specific point, it is assuming that the foreign jurisdiction provides the same exemption as well. So let's mainly focus on the first 2 points. The first one relating to dividends and capital gains. In order to avoid double taxation, first at the level of when the income is actually earned, and second at the level of when the dividend is paid or when the shares are sold by the shareholding company. This is in general not taxed in corporate taxation. Let's focus on the specific transactions that have been specified by the consultation document. Point 1. Dividends earned from UAE mainland companies. Point 2. Dividends earned from UAE free zone companies. Now point 3 to 6 have additional conditions to be met. So let's get into them. Point 3 is dividend earned from foreign companies. Number 4, sale of shares of UAE companies. Point 5, sale of shares of foreign companies. And finally, sale of share of free zone holding companies. Like we mentioned, point 3 to 6 have additional conditions that have to be met in order for them to be exempt. So what are the additional conditions that have to be met for these transactions to be considered as exempt? Firstly, the UAE company should have at least 5% shares in the foreign subsidiary. And number 2, the foreign jurisdiction should have at least 9% corporate tax. This is to basically avoid for profits to be transferred to no tax or low tax countries. Now let's get into exemption of foreign branch profits. We've already discussed in our older videos the difference between a branch license and a subsidiary license. In summary, a branch license is the same legal entity as the parent company, and the subsidiary license is a separate legal entity. And therefore, in a subsidiary license, 2 sets of books of accounts are maintained, while in a branch license, only 1 set of accounts is maintained. Here, the complication arises when the foreign jurisdiction where the branch company exists is also having corporate taxation. In such a case, the UAE company can either claim a foreign tax credit for the taxes paid in the foreign branch country, or elect to claim an exemption for the foreign branch profits. However, if this election is made, it is irrevocable and has to be done for all the branches. Also keep in mind, an exemption of the foreign branch profits can only be made if the foreign jurisdiction has sufficient level of corporate tax as well. The consultation document doesn't talk about how much tax is sufficient. However, we would have to assume that 9% is the sufficient level of tax. From this discussion, I hope you got a good idea of what income is stated as exempt income as per the corporate taxation consultation documents. We've now reached the end of our discussion. If you like the video, hit the like button and subscribe to our channel. If you want us to talk about any specific topics, please do let us know in the comment section below. See you in the next one.